All right. Well, welcome everybody. I'm Matt Montero, president of the Louisville FEI chapter. I want to welcome you all to our September meeting. Thank you, Terry. There I am. Except, yeah, back in the days when we would wear suits and ties, right? And get all professional and dressed up in front of everybody and gather together physically. Hopefully those days will return to us soon. I wanted to thank our gold sponsors. We had Chase Bank in our banking category is gold, MCM. I see Brad out there online. Good to see you, Brad. And Baco, saw Cliff joined in there with us too in our staffing category. Thank you for being our gold sponsors. We appreciate that very much. It enables us to keep our dues at minimum rates and save the local dues entirely. So thank you, sponsors. And we also had several silver sponsors as well too. Several of these are long-term sponsors. 2020 Best in Finance honorees. Over the past month, we've had the online awards for that, for the Best in Finance honorees. I wanted to recognize Mitch Wagner, Sean Woosley, and Mark Homan. So congratulations. And I want to welcome Marilyn. Marilyn moved from, gosh, was it Chicago or Detroit? I believe it was. Terry, did you just say?
Chicago.
Chicago. I was going to put my money on Chicago. Marilyn moved here to Louisville. She's SVP and CFO of the Presbyterian Foundation, a new member that joined here just in the past month. So I want to welcome Marilyn. We'll get to know her as well as we continue on with Zooms the next few months. We have a new addition to the FEI board, Michael Lynch, CFO, FKI or Fire King Security, has joined the board as a membership chair. We're really excited about that. Mike joined FEI a few years ago, in addition to the membership committee. We also have some open positions. One of them, for example, is the vice president role. So 2 years out, if you're interested in being on the board and maybe leading the organization in 2 years, we're looking to advance to that. And we'd love to get people involved on the board or on committees. So check out that tiny URL, and it's also on our website as well, where you can fill out a nomination form for yourself or someone else. Bardstown Bourbon Company, we have a tasting, kind of like we did last month with our social to kick things off, where we had our wine. We're going to have some a variety of bourbons, and I want to thank Ingrid for offering this, and it came together very quickly. We'll be doing that Tuesday, October 20th. So be looking forward to that, sponsors and members, and also any prospects that may be interested in this. It's going to be a lot of fun. And FEI Leadership Summit, we'll be doing this differently over a range of dates, doing it virtually. So look for registration opportunities for that. You can find it online or on our website for FEI Leadership Summit, October 6th to 22nd. I'll introduce Anthony Allen. We appreciate you getting Jonathan for us to speak about the CARES Act. Anthony, I'm going to let you go ahead and carry it away and go ahead and introduce Jonathan. But thank you.
Sure. Thank you, Matt. And good to see everybody. And Matt, if you're worried about calling me Tony or Anthony, you should hear what my wife calls me.
Yeah.
And other folks. So Tony's the least of my worries.
Yeah.
I appreciate it. So, the signing of the CARES Act into law presented, the business world with opportunity and uncertainty. So today we're going to discuss a couple unique strategies that have come to light through this. Number one, how to optimize the CARES Act to create and maximize liquidity. And number two, how to bring certainty to the SBA audit process of PPP loans. And so you've heard John's name mentioned, a colleague of mine, he's joining us, John Drummond. Just a quick intro for John. He's the head of our casualty broking for Willis North America, for which he's responsible for the overall strategy of the organization as far as broking is concerned. His primary focus is on aiding Fortune 500 clients in the development and implementation of complex casualty programs with a dedication to mitigating total cost of risk. So just a little bit about John there. I'm going to go ahead and turn it over to him at this time, and then I'll jump back in to talk later about the PPP loan.
Thank you, everybody, for your time today. Certainly appreciated, and look forward to spending a little bit of time just discussing the CARES Act and how you can effectively look for opportunities within the CARES Act to create liquidity, generate stimulus, and ultimately support your company. you know, we're all pretty familiar, I think, with the CARES Act in general, right? $2 trillion piece of legislation put through in March, provides stimulus funds for individuals, for families, for corporations, and it's a complex piece. So there's a lot of different provisions. The one specific provision that we're looking to discuss today is the net operating loss carryback provision. This provision, when utilized in the manner and the strategy that we'll discuss today, creates value and significant value in a few different ways. One is clearly it's designed to create a stimulus. So an injection of capital and cash today, right? You're utilizing previously paid taxes to create that, and we'll discuss how that works. Secondarily, for those that you retain, risk on your balance sheet, liabilities on your balance sheet, we can restore borrowing capacity through letters of credit that you currently might be disposing or utilizing to support your insurance program. And then lastly, is de-risking your balance sheet. So remove yourself from exposure to loss volatility and development, and ultimately put together a finite solution that really de-risk your balance sheet and de-risk the organization. The COVID economy, right? We're still in this very challenged state, and this challenged state is, from different economists, are projecting to play out for the next couple of quarters. If you really look at statistics as far as bankruptcies are concerned, bankruptcies are up significantly year on year. Through June, you had a 48% increase in bankruptcies year on year, and sadly enough, there's projected to be a continued influx of those. So how are companies managing this? Well, one of the ways they're managing it is through cash preservation and just a strong focus in on preserving liquidity. As I mentioned, the CARES Act has a lot of different opportunity to create that stimulus and create that liquidity. The one provision that we want to be able to utilize is that net operating loss carryback provision. Well, that provision was designed, and what it does is it allows companies that historically have performed quite well, might have had operating income in the last couple of years, could have paid taxes, income taxes over the last 2 years, but they move into 2020 fiscal year and it's challenged. Revenues have dropped, fixed expenses are staying the same, and they're stressed, many of which are posting net operating losses or projecting to be posting net operating losses in the current fiscal year. This provision allows companies to be able to take their net operating loss in this fiscal year and carry it backwards to any year in the last 5 where you might have had operating income. And by carrying that loss backwards, you're actually able to erode that operating income and reclaim historically paid taxes. The big driver in value here really comes from that 2017 tax year. So as we remember, we step back a couple years. In 2018, corporate tax rate went from 35% down to 21%. Well, this specific provision allows us to take a business expense today and carry it backwards to a time period where we actually paid a 35% tax rate. So we're able to enhance the value of today's business expenses dramatically, upwards of 66%. And by doing that, we're reclaiming these taxes, and that's serving as today's stimulus. As we think about, well, what are ways that we can utilize this strategy and really kind of maximize our return, maximize the liquidity that the organization can experience today? In the world of risk, we're uniquely positioned to help optimize the strategy. And what we're able to do is look at long tail liabilities that are carried on the balance sheet. For larger organizations who retain risk and have large deductible programs, that can come in the form of workers' compensation claims, pension liabilities, asbestos liability, auto liability, general liability, products liability, but these are risks as well as retained liabilities and obligations that you have that you're carrying on your balance sheet that are due in a future year. So one way I think that's easy for at least myself to think about this is workers' compensation. We know that if we have a portfolio of retained workers' compensation claims, well, those aren't just going to pay out today. They're not going to pay out this fiscal year. Those are injuries to employees that pay out over time. And what we want to do is take those future payments, and that's reflected really in these kind of gold boxes, if you will, squares. But we want to take future claim payments and future obligations and payment obligations associated with liabilities that we have on our balance sheet and pull those back into this current fiscal year. And by pulling those future claim payments into this fiscal year, we're actually able to enhance or even create a net operating loss. And by enhancing that net operating loss, we can then carry that backwards, upwards of 5 years, utilize that to reclaim previously paid taxes and create the stimulus. There's a couple different vehicles, and we won't get into all the details today because we just simply don't have time for us to accelerate future payments of these liabilities. Pensions and easy, right? Pensions working through different contributions. But as it relates to retained risk, you can utilize a captive, or you can utilize a loss portfolio transfer and actually sell the risk entirely itself. Let's move forward to this next slide. I'm going to just help to kind of create another visualization, if you will, of what this is. And then I'll take a pause and maybe open it up for any questions that we can submit through our chat function. This visualization here, you can see on the upper right, simple carryover from the previous slide. But what we're trying to do is accelerate future payments and pull those into this fiscal year. So in this hypothetical situation, we pulled $100 million worth of future payments into the 2020 fiscal year. By doing so, we're expanding the net operating loss by $100 million. And now we can carry that backwards through the CARES Act to be able to reclaim previously paid taxes. So in this hypothetical situation, we had in 2015, this company had $30 million of operating income, paid $10 million in tax. 2016, $35 million of operating income, and paid $12 million in tax. So it's kind of so on and so forth. Through this strategy, and what you're able to do is let's pull that net operating loss today back to 2015, and let's erode that operating income, reclaim that $10 million in tax. And we'll still have some of the net operating loss left, so let's push it forward to 2016. We can erode the operating income in 2016, reclaim that tax, and we even have some left over to move into 2017 and erode majority of that operating income and reclaim most of that tax. Ultimately, this strategy, what it does for a client is it allows them to create $34,500,000 worth of stimulus today by creating a net operating loss and really just repackaging liabilities that they have on their balance sheet. So we're not necessarily, we're not creating any new liabilities. We're taking those liabilities that already exist, repackaging those liabilities, and effectively helping create an opportunity to expand a net operating loss today. Let's stop there for a minute, because I want this to be a dialogue. I want you to get as much as you can out about this presentation, and I'll create an opportunity and window for you to just submit a question through the chat function. And I'm going to, in the process, look on pulling up that chat function.
While people are chatting in any questions, or if they raise their hand in the meantime, are these through certain tax vehicles that need to be developed in order to take advantage of these opportunities, or is it just standard accrual accounting that to be aware of the things that all things that need to be accrued that can be accrued, or maybe it's a combination of just properly accruing and specialized vehicles that maybe need to be worked with an accounting firm or Willis Towers Watson, for example? You could just expand on that a little bit.
Yeah. Can maybe restate that question, and I can work to answer it.
In order to take advantage of these future losses or future liabilities, is it just through being aware of the proper accrual accounting that needs to be done, or are there special, tactics that need to be utilized in order to be able to take advantage of those future liabilities and record them as expenses?
Yep. So what we need to do is put those liabilities, those future liabilities, into a vehicle that allows us to recognize the payment of them as an expense today. Just typically sitting out there as they are and paying them as they come up would not funnel those expenses into this fiscal year. So we do need to take action, and that's where we look at leveraging a loss portfolio transfer or leveraging a captive to be able to help put them in the vehicle they need to be in to be able to accelerate that tax deductibility, meaning push that expense into this fiscal year. And Terry, that might actually, kind of allows me to touch upon that second bullet point. Companies that are, if you think about it, not all companies, but some companies that are in a challenged state, have a net operating loss this year, they might say, well, this makes sense all day long. And then I'll talk about a live example that we're working through and how this just helps them out. But they might say, hey, I'd love to do this, but I don't have $100 million in cash right now that we can go execute this strategy on. So what I would say our organization and other organizations too have been successful in doing is lining up capital sources, because there's a lot of different capital sources out there that are willing to buy into this strategy, extend capital to help support the strategy. So secure the capital from these capital sources, then go take that $100 million in capital that you just received, execute the strategy, create the $100 million net operating loss, carry that backwards, and utilize it to reclaim these taxes. And so that is something that people have been doing, especially in light of this day and age where, hey, cash is king, and this might be the greatest strategy in the world, but certain companies need some help being able to fund it. And what's interesting too is the amount of alternative capital that's very interested in deploying the capital that they have in unique manners. So you have, conventional banks, certainly they have their ABLs that they set up and they look at different assets, but there's a lot of capital sources in the insurance world, as well as in hedge funds and investment banks, that want to align capital looking at atypical, non-conventional assets to be able to help support different extensions. So whether that's inventory, whether it's an equipment type leaseback, intellectual property has been very big lately. Whether you have your own technology or platform within your organization that you organically developed, or let's say that you work with Oracle and Oracle has developed a product for you that helps you manage your business. You can leverage that intellectual property and allow these capital sources to extend their capital at marketable rates, the same rates that you'd experience through conventional banks. And by utilizing these alternative forms, companies are really able to get the most out of the organization and put the assets to good use. So that's something that you might consider to look at as you're thinking about opportunities to fund CapEx projects or fund strategies like the one that I'm discussing today. Okay. Let's kind of move forward a little bit here. Here's a live example of something we're working through. Multi-billion-dollar company that's in that recreation and hospitality space. Historically, they've done very well, but they move in today's economy and they're challenged. They're going to be posting a net operating loss, and they're looking for any way possible to enhance liquidity. They currently have about $20 million of workers' compensation liabilities on their balance sheet. They're underfunded on their pension by $100 million. And they understand the value that the CARES Act really presents. and said, we want to do this, but we can't afford it. We can't deploy the cash to be able to do this. How can we work through this? So first is still understanding the economics of the deal. So for this organization, being able to enhance their net operating loss for this fiscal year by $120 million is going to create $42 million of cash, a cash infusion right now for them. It's going to eliminate the collateral expense that they have. So this organization has to put up letters of credit to support their workers' compensation portfolio. Well, those letters of credit are doing two things. One, there's the servicing expense with the $20 million letters of credit. That's going to go away when they execute the LPT. Secondarily, and for a lot of CFOs, this is probably even more important, is that they're able to take that $20 million in letters of credit and bring those back to the company. So they're restoring the borrowing capacity under the corporate credit revolver by getting those letters of credit back to the organization. And lastly, and a big value contributor that we did analysis on is mitigating their PBGC tax. So that's associated with the pensions. And they equated that, we're thinking it's about going to be a 4% relief on their PBGC tax associated with that underfunded pension. How they're looking to do this, what's going on, they're leveraging a portion of their real estate portfolio to be able to secure capital financing for this. That term loan is actually mimicking their current cash flow obligations underneath both their pensions funding strategy as well as their workers' compensation portfolio. So the cash outflows are mirroring that they already experience in the company. They're able to execute and secure that $42 million stimulus today. They're enhancing the value of today's business expense by 66% because they're actually bringing back to fiscal years 2015 and 2016. And lastly, as they look at that, they're like, well, at least we're going to be able to take some tax deductions on this term loan. So that's another small added benefit. But for this organization, where liquidity was critical and finding opportunities to be able to, enhance their cash position, this was a big deal for them. All right. Lastly is timing. So if you look at your organization and if this might make sense, it's important to act now. This provision of the CARES Act expires at the end of this fiscal year. So if you're on a calendar year fiscal year, expires at the end of 12/31. If you're on a non-calendar year fiscal year, you have a little bit more time. The strategies and vehicles that you'll need to leverage and utilize to be able to accelerate future tax deductions is they take a while to put together. And sometimes it can be upwards of 60 plus days to be able to execute and put those liabilities in the right vehicles. So now's the time to act, particularly if you're on a calendar year fiscal year. But the good news is that there's typically a considerable amount of value that can be presented here. Anthony, I'll kick it over to you to talk a little bit about the PPP loan contingency insurance, and maybe we can open up for questions afterwards.
Sure, thanks, John. And if we want to pause here, I did see a question come through from Bill in the chat. I think I know the answer to this, but I'll let you take it. But Bill's question says, I have the opposite problem of not being able to use prior period NOLs. Is there a similar solution to mirror this strategy such that prior period NOLs are utilized?
So you can work, I'm not a tax guy, right? But this particular CARES Act was designed to be able to allow companies to monetize prior year NOLs. So if you did have an NOL in 2019, and I believe some of those in NOLs in 2018 are valid as well, you can deploy those in this strategy. We actually worked with Deloitte kind of as a partner on this a little bit, and I'd be happy to put you in contact with the subject matter experts over at Deloitte. But my understanding, and I'm not a tax guy, is that you actually can put to use your prior year NOLs if that's of interest.
Thank you. And we'll just stay on the topic if it's okay with everybody. So a question from Mark. It says, do you have to use an offshore captive? And speaking to the timing, says it seems aggressive to put together a captive in a couple of weeks. So.
Yep. So you're good question. No, you do not need to use an offshore captive. It can be an onshore captive. It's the offshores, the domicile does not matter. And as it relates to timing, so to be able to execute, and I'll bring it back to that page, execute on that 30-day capital establishment, that's through effectively utilizing a rent-a-captive, which, and this isn't meant to be a plug for Willis Towers Watson. We have a rent-a-captive facility, so does other brokers, right, that you could utilize for this strategy. So there's facilities already out there set up, ready to roll for you to go in and utilize for the strategy. Now, if you had the desire to build your own captive, that still can be done, but it's about an 8-week process, and there's probably a lot to do it towards year end. So we're probably, that's why we wanted to really get this in front of you as soon as possible, because there's a window of time that's kind of quickly ticking by.
Great, thanks, John.
Yep.
Let's go back to the PPP slides, and John spoke to the opportunities presented by the CARES Act. I'm going to speak a little bit to the uncertainty around specifically the PPP loan and the SBA audits. Looking at this page, simply just a highlight of the figures that I think we're probably all pretty familiar with, given the reporting on it. So $500 billion in loans approved, $5 million or 5 million loans countrywide, and specific to Kentucky, $1.5 billion in loans out there. So, we're talking about a lot of money out there. And if we go to the next slide, the government and the SBA are certainly cognizant of the fact that there's a lot of money out there, and they're going to do their best to make sure that, the loan process and the loans that were issued were done so appropriately and to applicants that qualified for the loan. You'll see there on the slide. This is straight from the SBA. If the SBA determines that a borrower is ineligible for the PPP loan, they'll direct a lender to deny the loan forgiveness application, and they go on further to say that they will seek repayment of the outstanding PPP loan balance. So on the next slide, really what they are going to be focusing on is around the application, the necessity, and the affiliation rules. Now, certainly there's going to be some looking at the how you utilize the money, but in my opinion, our opinion, that's not really where the uncertainty comes from. That's going to be pretty cut and dry, pretty black and white as far as did you use the money as you were supposed to. So where the uncertainty comes from the application process is really focused on two areas, and really the necessity certification really drives this. As you look at the wording on the application, it's current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. They came out further with guidance that as you're looking to apply for this loan, recipients should consider access to alternative sources of capital or of liquidity prior to making the necessity certification. So this is, in our conversations with folks, this is where people are concerned, if they've taken a loan, how long is this going to hang over their head? They certainly felt like they, like the loan was warranted. They wanted to get the application in, but some of this language kind of gives them a little bit of concern. And so the market recognized that there's financial risk associated with the loan and uncertainty given the SBA audits, that someone could take a $5 million loan and 3 years later they're audited and the SBA determines that they shouldn't receive that money, and now they have to pay that back, and it can be a significant hit to the cash flow. So John, if you'll slide to the next or move to the next slide. Like I said, the market recognized this, and when I heard about this product in the market, and as well as the strategy around the CARES Act, I reached out and instantly thought of the membership. Just wanted to make everyone aware, if they weren't already, of some unique strategies, not only to to maximize opportunity, but also to address some of this uncertainty. So this slide simply a highlight of the insurance product to de-risk that the SBA audit uncertainty. The insurance product acts as a backstop to the certifications, again, to the necessity and the application rule. And it's going to apply to loans 2 million or greater, and that's largely because of the focus that the SBA has come out and indicated that loans above $2 million are going to get more attention than others. So that's where the product is focused. I guess kind of the energy per se. They're going to focus on anything above that is where they're willing to look at an applicant and potentially insure them. Pricing on this is transparent. It's going to range from 4 to 6% of the loan amount, and that's that 4 to 6%. It's a range based on the size of the loan, the perceived risk of the application of the applicant, and there's a retention deductible amount, as you see, approximately $200,000. So really straightforward insurance product. Like I said, just wanted to get this on everyone's radar. This is not something that's exclusive to us. It's out there in the marketplace, but because of the unique situation created by the PPP loan and the uncertainty, I want to make sure that everyone's aware of it. I don't have any more details on the loan itself. If you all have it, or the product itself, if you have any specific questions, happy to address them. And I'll stop there.
Okay.
People are interested in this, Anthony, then they would reach out to you as a contact, correct?
Sure, absolutely. You can reach out to your broker if we're not working with us, or if you want to reach out to us, happy to take that call and see if we can help out.
Yeah, I was not aware that there was an insurance product available. Sounds like a natural, outcome of having the uncertainty of the PPP loans being forgiven, but it's good to know that that's an option.
So, Mark, I see your question. It says contingency insurance limitations are what? Could you expand on the question of the limitations?
Sorry, I had to get myself unmuted, Anthony. Or is it Tony? and Tony.
You.
There we go. Well, I guess when you look at the prior slide and kind of the bullet points, obviously if you did something that wasn't appropriate, I mean, just maybe can give me an example of what the certification that, okay, I blew it on one of those things because I accidentally did it. I mean, can you just maybe expand a little bit upon how the insurance works? Because if I just didn't answer something correctly intentionally, I'm sure the insurance isn't going to pay for that, right?
Yeah, I mean, I guess if you're looking at providing inaccurate information, I think that would be we have to look at the language of that the policy, and each one of these is a manuscript, unique form, given the nature of it. But so an example of a company that we're talking with now is a construction company, and really what their concern around the necessity factor is, where the SBA guidance is saying, did you look at alternative sources of liquidity before making this necessity certification? This company in particular is a heavy civil highway construction company, and so they maintain a significant amount of liquidity for their bonding program, and so their main concern was, look, we're multi-million-dollar construction company, and if the SBA comes in and doesn't understand our liquidity requirements because of our bonding program, could they look at this and say, gosh, you guys didn't need the money, you're sitting on, millions of dollars in cash, you didn't deserve this loan. And, so now they're being called back for, a $6 million loan a few years later. And, naturally that's a big hit. So that's a situation, for them that gives them heartburn, and for them, they say, hey, for 4%, I can be rid of that concern now and not have that hanging over my head for 6 years. And so that's where the hedge comes in. It's likely not going to be for everybody. If someone feels, that this, their application is very strong and they don't have those type of concerns from the nuances, probably not a solution for them. But if it's something that's being talked about, within the organization of, we're worried about this, it could be a good fit. And when you look at the long-term spend, this is annual pricing. This is the policy that goes through the term of the audit period. So it's that is spread out.
Yeah, that's very helpful to have an example like that. Now I understand a little bit more kind of what your risks are.
Thank you for the question. I don't see anything else in the chat. If anybody else has a question, wants to come off mute, or if there's no further questions, we certainly appreciate everyone's time, and we can turn it back over to Terry and Matt.
We can bounce back and forth between questions as they come up between the PPP and John's presentation, but a question that was added on about John's presentation, can you explain the rent-a-captive? I know you talked a little bit about it, but maybe if you can go into it in a little bit more detail.
Yeah, certainly. So at a high level, what it does is that it's the infrastructure of the captive is already put in place. So you already have effectively we've put in the Articles of Confederation, we've started the captive up, we have the surplus already built out, we have the papers filed, we have fronting carriers figured out. So all of those elements are already set and established. And this allows you to come in and build out and utilize a captive facility for whatever risk strategy you like, whether it's carriers oriented or not, but being able to kind of be a one-stop shop and not have to go through the burden of being able to establish one yourself.
Let's go ahead and go through these 3 polls real quick, and that
great.
Let some discussion here.
As we're kind of working through these polls too, another strategy that we've seen companies really appreciate in this time where liquidity creation and preservation is a high strategic priority, is finding alternative markets here that, again, want to be able to extend capital and leverage unique assets, whether it's first priority assets or second priority assets, to be able to create financing opportunities. There's new letter of credit facility out there that's called stock or asset-backed letters of credit. And that allows a company to look at non-conventional assets on their balance sheet. So whether it's a hospital utilizing Medicare and Medicaid receivables, or a company that has a large auto fleet and be able to take equity they have in the large auto fleet to be able to create letters of credit capacity to support their organizations. There's a number of companies that have just found a lot of value in that, because this alternative letters of credit capacity allows them to open up the letters of credit and bring those back to their corporate credit revolver, utilize those for working capital needs, take the new letters of credit and put those to work for the organization, securitizing different obligations. So as you think, if your company kind of fits that mold where you're looking for different ways to be able to create capital and leverage assets, there's a marketplace out there that's pretty innovative, and happy to discuss that with you as well.
Okay. Then the last of the 3 polls is essentially when do you expect business to return to normal? Second quarter, third quarter, 2021. So, even out to 2022 and no return to the old normal. Interesting.
Refuse to accept that.
Yeah, exactly. Before I forget, first of all, thank you, John, Anthony, both. Really appreciate it. This was great information, and
This
yeah,
is John.
yeah. There you go.
Anthony has promised to personally deliver it to John.
Yeah,
An
excellent.
empty bottle.
It might be empty by the time he gets it.
Okay, here's what I'll do. I'll go ahead and I'll call the meeting as far as anyone who has to jump off and move on to anything else. Folks that would be interested in a breakout room, please stay on the Zoom. And John, Anthony, just depends on your availability. We'd love to include you if you are available. Anyone who can't join, then that is perfectly fine. But what we'll do is we'll have a clean break here for anyone who needs to go, and remaining folks stay on the line and we'll break out.